Welcome back, fellow investors, to another episode of Stock Maven. Today, we have a topic that's been making waves in the financial world: the dreaded death cross. It's a term that can send shivers down the spine of even the most seasoned investors. But what exactly is it, and what does it mean for your stocks? Stay tuned as we unravel the mysteries of the death cross. Before we dive into the nitty-gritty of the death cross, let's start with the basics. In the world of technical analysis, charts and patterns are our crystal balls. They provide insights into potential market movements, and one of these patterns is the death cross. But why such a grim name? Well, that's what we're here to find out. So, what is this death cross everyone's talking about? The death cross is a technical pattern that occurs on a stock chart when a stock's short-term moving average crosses below its long-term moving average. Typically, the short-term moving average is the 50-day moving average, and the long-term one is the 200-day moving average. Before we go any further, let's clarify what moving averages are. In simple terms, a moving average is a calculation that smoothens out a series of data points by creating a constantly updated average price. It helps investors identify trends by eliminating daily price fluctuations. Here's a visual representation of what the death cross looks like on a stock chart. As you can see, the blue line represents the 50-day moving average, and the red line represents the 200-day moving average. When the blue line crosses below the red line, it forms the death cross. Now, let's get to the heart of the matter. Why does the death cross matter, and what does it mean historically? The death cross is often seen as a bearish signal, signaling a potential downturn in the stock's price. It's like a dark cloud looming over your investments. The significance of the death cross lies in market psychology. When investors see this pattern forming, it can trigger a wave of selling, leading to further price declines. It's a self-fulfilling prophecy, where fear and uncertainty can drive stock prices lower. However, it's essential to note that not every death cross leads to a market crash or a significant decline. There have been instances where the death cross turned out to be a false signal. That's why it's crucial not to rely solely on this pattern when making investment decisions. On the flip side, we have something called the golden cross, which is the opposite of the death cross. It occurs when the 50-day moving average crosses above the 200-day moving average, signaling a potential uptrend. Investors often welcome the golden cross with open arms. To truly understand the implications of a death cross, we need to consider several factors. First, it's essential to look at the broader market context. Is the market already in a bearish trend, or is it just a temporary dip? Additionally, don't forget about fundamental analysis. Look at the company's financial health, its earnings reports, and any significant news that might impact its stock price. A death cross alone shouldn't be the sole basis for your investment decisions. Let's take a moment to explore some real-world examples of the death cross and how they played out. We'll examine historical cases where stocks experienced a death cross and what happened next. These case studies will provide valuable insights into the dynamics of the death cross and how it can vary from one stock to another. So, what should you do if you encounter a death cross in your portfolio? Should you panic and sell everything? Well, not necessarily. There are various strategies you can consider, depending on your investment goals and risk tolerance. One approach is to take a long-term perspective. If you believe in the fundamentals of the company and its long-term growth potential, you might choose to ride out the storm and even consider buying more shares at a discounted price. Another strategy is to set stop-loss orders. These are predetermined price levels at which you're willing to sell your shares to limit potential losses. It's a way to protect your portfolio from further declines. Diversification is key. By spreading your investments across different asset classes and sectors, you can reduce the impact of a single death cross on your overall portfolio. Lastly, consider consulting a financial advisor. They can provide personalized guidance based on your specific financial situation and investment objectives. In conclusion, the death cross is a technical pattern that can be a cause for concern, but it's not a guaranteed harbinger of doom for your stocks. It's essential to analyze the broader context, consider fundamental factors, and have a clear investment strategy in place. That wraps up today's episode of Stock Maven. Remember, the world of investing is full of twists and turns, but with knowledge and a well-thought-out strategy, you can navigate it successfully. If you found this video informative, please like, share, and subscribe to our channel for more insights into the world of investing. Until next time, happy investing, and stay tuned for more from Stock Maven.